Okay, so you want to own an oil refinery. In your head, it's a skyline of steel towers breathing fire against a sunset, tanker trucks rolling out the gate every 90 seconds, and a number on a screen that just keeps climbing while you sit in an office somewhere counting the money that America's cars, planes, and factories can't survive without. You own the thing the entire economy runs on. What could possibly go wrong? Here's the problem. Almost none of that is how this business actually works. What you're picturing is a cash machine. What you're about to buy is one of the most brutal, thin-margin, capital-eating industries on the planet, and one where a single bad Tuesday can wipe out a year of profit before lunch. Let's talk scale first, because the scale is what fools people. The U.S. refining industry processes somewhere around 18 million barrels of crude oil every single day, across roughly 130 operating refineries. That's an industry that turns over more than $500 billion a year in refined product sales. Sounds like an empire, right? Now here's the number that actually matters. The average refining margin, what you keep per barrel after buying the crude and turning it into gasoline, diesel, and jet fuel, usually lands somewhere between $2 and $8 a barrel. Not 200, not 800, $2 to $8 on a barrel that just cost you $70 to $90 to buy. You're running one of the largest, most explosive, most regulated industrial operations on Earth for a margin that a decent taco truck would laugh at. Refinery isn't one business. It's 4 different businesses wearing the same hard hat. There's the topping refinery, the simplest version, basically a glorified distillation tower that separates crude into fractions and does little else. Cheap to run, but stuck selling low-value products because it can't upgrade anything. There's the cracking refinery, which adds a catalytic cracker to break heavy molecules into lighter, more valuable ones like gasoline, better margins, meaningfully higher capital cost. There's the coking refinery, the heavyweight version, built to eat the ugliest, cheapest, heaviest crude and squeeze premium fuel out of it. The most profitable per barrel, and also the most expensive plant you will ever build. And then there's the integrated majors refinery, bolted onto a company that also pumps its own crude and owns the gas station selling the final product, which isn't really refining as a standalone business anymore. It's one link in a chain designed to protect the company from exactly the kind of margin collapse that kills everyone else on this list. So before you've refined a single drop, you need to know which of those 4 businesses you're actually in. Most people who fantasize about owning a refinery are picturing business 4. Most people who can actually afford to build one end up stuck in business 1 or 2. And the split isn't cosmetic. It's measured with a real number the industry lives and dies by, called the Nelson Complexity Index. A simple topping refinery might score a 2 or 3. A fully loaded coking refinery can score 12, 14, sometimes higher. Every point on that scale roughly correlates to how much of a barrel of cheap, ugly crude the plant can turn into premium product instead of waste. It also roughly correlates to how much that plant costs to build, and how much it'll cost you to fix when something inside it breaks. High complexity means high margin potential and high exposure all at once. Low complexity means you sleep easier and earn less. There's no version of this where you get both. Now let's talk about getting in the door, because this is where the fantasy starts to physically hurt. Nobody has built a new, full-scale grassroots refinery in the United States since the late 1970s. Not because nobody wants to, because the entry cost is close to prohibitive, and the permitting timeline can outlast a presidency. A new mid-size refinery in the 150,000 to 250,000 barrel per day range runs somewhere between $8 billion and $15 billion in construction costs alone. Add land acquisition near deepwater port access or crude pipeline infrastructure. Call it $50 million to $300 million depending on location. Add environmental permitting, air quality modeling, and community review, which can run $50 million to $150 million in legal and consulting fees before you've poured a single foundation, and can take anywhere from 5 to 15 years to clear. Add the actual process units, crude distillation towers, catalytic crackers, hydrotreators, sulfur recovery units, storage tank farms, which is most of that $8 to $15 billion. Add initial working capital just to fill the tanks with crude before you've sold a gallon, $200 million to $600 million, because crude oil inventory for a plant this size is genuinely that expensive to hold. Total realistic entry cost for a real competitive refinery, somewhere north of $10 billion before you've made a single dollar. And that figure assumes nothing goes wrong. No permit challenge, no supply chain delay on specialized reactor vessels that sometimes take 2 years just to fabricate and ship, no cost overrun on a project this size, which is a naive assumption in an industry where multi-billion-dollar refinery expansions routinely blow past budget by 30 to 50%. This is the point where most people quietly close the laptop, which is exactly why almost nobody builds new. They buy old. Existing refineries trade for a fraction of replacement cost, sometimes $2,000 to $6,000 per barrel of daily capacity instead of the $40,000 plus per barrel it costs to build new, because the buyer isn't paying for a fresh asset. They're paying for a permit that already exists and a community that's already made peace with the flare stack on the horizon. That permit, not the steel, is the actual product being sold in most refinery acquisitions. Nobody outside the industry thinks about it that way. Everyone inside the industry thinks about nothing else. Okay, you've somehow cleared that wall. Now, where does the money actually come from? Layer 1 is the one you already assumed was the whole business, the crack spread. You buy crude, you refine it, you sell the output gasoline, diesel, jet fuel, and the difference is your margin. This is what everyone pictures as the refinery business. Here's the twist. It's usually the weakest, most volatile layer of the whole model. Crack spreads move with weather, wars, seasonal driving demand, and OPEC mood swings, and they can flip from healthy to negative in a matter of weeks. If crack spread were the entire business, most refineries would be unprofitable more years than not. Layer 2 is where it gets more interesting. Byproducts. A barrel of crude doesn't turn into gasoline and diesel alone. It also throws off asphalt, petroleum coke, sulfur, propane, and petrochemical feedstocks like naphtha, which get sold separately, often to entirely different buyers in entirely different industries. A well-run refinery can pull 10 to 20% of total revenue from byproducts most viewers have never heard mentioned in the same sentence as oil refinery. Asphalt alone, sold to paving contractors, can be a meaningfully stabilizing side income precisely because road construction demand doesn't move in sync with gasoline demand. Petroleum coke gets sold to cement kilns and steel mills as a cheap fuel source. Sulfur, once considered a disposal headache, now gets sold into fertilizer production. None of this is what the viewer pictures when they imagine a refinery's product line, and that's exactly the point. The byproduct stream is quietly doing work the crack spread gets all the credit for. Layer 3, and here's what nobody outside the industry actually understands. RIN. Under the EPA's renewable fuel standard, refiners are legally required to blend a certain percentage of renewable fuel, ethanol, biodiesel, into what they sell, or buy compliance credits called renewable identification numbers to cover the shortfall. Refiners that blend efficiently generate surplus RINs and sell them on an open market. Refiners that can't blend efficiently have to buy them, sometimes at painful prices when RIN markets spike. In volatile years, RIN costs or RIN revenue can swing a refiner's bottom line by hundreds of millions of dollars. A compliance mechanism functioning as a full, separate profit or loss center that almost never shows up in the popular imagination of how a refinery makes money. Layer 4. Tolling and terminal fees. Big refiners with excess capacity or strategically located storage will process crude for other companies for a fixed processing fee, or rent out tank space and pipeline access to traders who need somewhere to park barrels. It's boring, it's not glamorous, and it's some of the steadiest income in the entire model, because it's a fee, not a margin, and fees don't collapse the way commodity spreads do. So the real business isn't buy crude, sell gasoline. It's four separate revenue streams stapled together, and the one you thought was the whole point, the crack spread, is often the least reliable of the four. Here's the trap almost nobody talks about outside industry circles. Refiners actively manage RIN exposure and crack spread exposure through the futures market, hedging months in advance using NYMEX crack spread contracts, essentially betting on their own future margins to lock in profitability before the barrel is even purchased. A refiner might lock in a 3-2-1 crack spread, the ratio of 3 barrels of crude converted into 2 barrels of gasoline, and 1 barrel of distillate, months ahead of actually processing the crude, sacrificing some upside in exchange for guaranteeing they won't get caught on the wrong side of a sudden margin collapse. It's financial engineering layered on top of an industrial business, and the refiners who survive downturns are usually the ones who are better traders, not better chemists. That's the real skill this industry rewards, and it's almost never the skill the public imagines when they picture a refinery owner. The plant is the collateral. The trading desk is where the business actually gets won or lost. Now the bleed. Every single day this plant runs, it eats money whether or not the crack spread cooperates. Labor. A mid-size refinery employs anywhere from 400 to 900 skilled workers, process operators, mechanical engineers, electricians, often unionized, with fully loaded costs, wages plus benefits, running $120,000 to $180,000 per employee annually. That's $50 million to $150 million a year before you've refined a barrel. Maintenance and turnarounds. The scheduled shutdowns where the whole plant goes offline for weeks to inspect and rebuild major units happen every 3 to 5 years and cost $50 million to $150 million each time. Plus every single day of that shutdown is revenue you're not making. Energy. Refineries are famously energy hungry, often burning 5 to 8% of the crude oil they process just to power their own operations, which at scale is tens of millions of dollars a year in fuel the plant consumes just existing. Environmental compliance and emissions monitoring adds another $10 million to $40 million annually in permits, continuous monitoring systems, and remediation reserves. Insurance on a facility this combustible, this chemically hazardous, and this expensive to rebuild runs into the tens of millions annually on its own. And after a major incident anywhere in the industry, premiums for everyone else tend to jump too. The whole sector shares the risk pool whether it wants to or not. Then there's the software and compliance layer people never picture. Continuous emissions monitoring systems, process safety management software, third-party auditing, wastewater treatment permitting, another handful of millions a year just to stay legally allowed to operate. None of these costs care whether crack spreads are wide or negative that week. Time isn't neutral in this business. Every idle hour is a cost with no offsetting revenue, and unlike almost any other asset class, this plant cannot simply be turned off and back on cheaply. A cold restart after an extended shutdown can itself cost millions and take weeks. And now the one domino. Here's the catch that makes refining structurally different from almost every other capital-intensive industry. A refinery is not a collection of independent machines. It's a single continuous chemical process. If the fluid catalytic cracker, the single most valuable unit in the plant, goes down, the entire refinery's output and profitability collapses with it, even if every other unit is running perfectly. There's no redundancy in most refineries for their core process units, because building a backup cracker would functionally mean building a second refinery. That single point of failure isn't bad luck. It's baked directly into the design economics of the plant, because redundancy at this capital scale would destroy the margin that barely exists in the first place. Which brings us to the real story. In June 2019, Philadelphia Energy Solutions, operator of the largest refining complex on the East Coast, processing around 335,000 barrels a day, a facility with roots going back over 150 years, suffered a catastrophic explosion and fire in its alkylation unit. Nobody died, which given the scale of the blast was close to a miracle, but the damage was severe enough that the company filed for bankruptcy within weeks and permanently shut the refinery down. Over 1,000 direct jobs disappeared. The insurance claim eventually settled north of $1 billion, and the site, one of the oldest continuously operating refineries in the country, never processed crude again. That's not a story about bad management. PES had survived previous bankruptcies and kept running. It's a story about what happens when the one structural weak point every refinery carries actually gets hit. One unit, one incident, and 150 years of industrial history is over in a single afternoon. What makes the PES story sting even harder is the timeline leading up to it. The company had already filed for bankruptcy once before, in early 2018, restructured its debt, and come out the other side telling investors and workers the plant had a future. 18 months later, a corroded pipe elbow in the alkylation unit, a component whose entire job is to handle one of the most dangerous chemicals in the refining process. Hydrofluoric acid failed, triggered an explosion that hurled a piece of debris the length of a school bus more than 2,000 feet across the property, and set off a fire that burned for days. Regulators later found the company had known about corrosion risk in that exact unit and hadn't replaced the failing component in time. The refinery never processed another barrel, a site that had operated in some form since before the Civil War, through world wars, oil embargoes, and multiple ownership changes, was gone in an afternoon, not because the business model failed, but because one pipe did. So how do the smart players avoid that fate? They don't avoid the risk, they dilute it across scale nobody else can match. Companies like Marathon Petroleum, Valero, and Phillips 66 operate not one refinery but a dozen or more across different regions. So a single unit failure at one plant is a bad quarter, not a bankruptcy. The true integrated majors go further, owning the crude production upstream and the retail gas stations downstream. So when refining margins collapse, they're often still making money on the crude side. And when crude prices spike, their retail margins usually absorb some of the pain. The same commodity swing that bankrupts a standalone refiner barely dents a fully integrated one. And increasingly, the smartest capital in the industry isn't expanding traditional refining at all. It's converting older, less competitive refineries into renewable diesel plants, chasing federal tax credits, and a growing low-carbon fuel market instead of fighting for scraps of crack spread. Ownership at this level isn't really about the industrial process anymore. It's about which side of the volatility you're structurally positioned to survive. Let's put real numbers on the swing, because volatile is a word, and this is a business built on decimals that turn into fortunes or funerals. A good year, 2022, post-invasion of Ukraine energy shock, when diesel and jet fuel demand outran global refining capacity and crack spreads spiked to historic highs. Some U.S. refiners posted per barrel margins north of $30 to $40, turning a 200,000 barrel a day refinery into a facility generating well over $2 billion in annual gross refining margin, before a single byproduct or RIN dollar got counted. A bad year, 2020, when COVID demand destruction crushed jet fuel and gasoline consumption simultaneously. Crack spreads briefly went negative in some regions, and refiners were, quite literally, losing money on every barrel processed. Several U.S. refineries never reopened after that year at all. Same industry, same plant design, a swing of tens of dollars per barrel separating record profit from permanent closure, sometimes inside an 18-month window. And here's the part that should genuinely unsettle you. The operator running the plant during the record year and the operator running it during the collapse were often making the exact same operational decisions, running the exact same crude slate through the exact same units. The plant didn't get smarter in 2022 and dumber in 2020. The world around it just changed, and the plant had no say in the matter. That's not a business risk you manage away with better management. That's a risk you either have the balance sheet to absorb or you don't. So is it worth it? Depends entirely on which version of this business you're actually buying into. If you're a standalone operator with one plant and no upstream or downstream integration, this is one of the worst risk-adjusted businesses in industrial America. Capital intensive, margin thin, one mechanical failure from bankruptcy, and completely at the mercy of a commodity swing you don't control. If you're a major with scale, integration, and the balance sheet to survive a bad 18 months without blinking, refining becomes something closer to what people originally imagined. A slow, occasionally spectacular cash engine, propped up by fee income and byproducts even when the headline crack spread goes ugly. This industry doesn't reward passion or ambition. It rewards balance sheets big enough to lose $1 billion in a bad year and still show up to work Monday. If you're picturing yourself as the plucky independent who buys one aging plant and turns it around through grit alone, that's the plot of a movie, not a business plan, and the graveyard of shuttered independent refineries from the last 2 decades is longer than the list of survivors. This is a scale game, full stop. The only question worth asking before you write the check is whether you're bringing scale to the table or hoping the table brings it to you. An oil refinery was never really the product. It was a bet on volatility, made by whoever could afford to lose that bet more times than everyone else at the table.